Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and on this special edition, our focus is on the Q3 earnings. Tire maker CEAT has reported a five-fold jump in the profits for the third quarter. The net profit has soared 417% on a year-on-year basis to over 181 crore rupees, and this is beating the estimates that largely the street had. Revenues for the Mumbai-based company also saw an 8.6% rise at about 2963 odd crore rupees in the October to December quarter. However, this marginally missed the analyst estimates. Now, to discuss some more insights from the earnings this quarter and the outlook going forward, I'm joined by the top management of the company. Mr. Kumar Subbiah now joins in. He's the CFO of CEAT, joining right here. Welcome, sir, and thank you so much for taking the time to speak to us about your quarterly earnings. Tell us, a five-fold jump in profit. What were the key factors to start off with that really contributed to this sharp surge in the profit after tax this quarter, and the outlook also going forward?
No, first of all, a pleasure to be part of your show. So thanks for inviting me. It's been a very satisfying quarter, and after this is the third quarter in succession that our fourth quarter in succession that we have reported a double-digit margin. And in the previous 2 years, thanks to steep increase in commodity prices and the lag involved in terms of passing on the impact of commodity prices through increase in selling prices of tires, led to drop in margins. So as far as we are concerned, I think the worst is behind us, and we are in a comfortable zone. Coming to your question, what had led to increase in profits fivefold? Largely, I think our gross margin improved substantially between these two periods by little over 500 basis points. And second is that top line growth, and third is that price mix. These three things played a role. Gross margin improved. We were able to ensure that the improvement in gross margin also led to improvement in EBITDA and profits. So therefore, and the gross margin improvement is because of series of price increases that we took last year progressively, and a drop in commodity prices and stability in commodity prices helped. And last is that top line increase. Coming to the second part of the question on growth, how the market looks like. Normally, a quarter three is a weaker quarter compared to the rest of the three quarters. So therefore, analyst expectations on quarter three would have been a growth quarter on quarter. Okay, but we declined quarter on quarter because in quarter three generally it tends to be a weaker quarter, and both from OEM side, from the replacement side, that it happened. In quarter three, we grew strongly both in replacement as well as in the export segment. Original equipment segment was flat, and quarter four we expect it to be a good quarter. Okay, we hope, with the pickup in infrastructure and economic activities, normally it has a telling effect on the demand, particularly for commercial category of tires and the rural demand. We look forward to a better quarter in quarter four.
Better quarter in quarter four, that's the outlook. Since you talked about margins, sir, give us a picture of what would be a sustainable band of margins that you're looking at growing it, because 14% right now, is this sustainable going forward? You did talk about the factors at play, including the raw material prices, the price hikes that you took. So what is the trajectory on all of these three factors going forward? The margin band, the raw material outlook, as well as the pricing outlook that you have.
Yeah, sure. No, instead of giving an outlook, I'll just tell you where we are, what are the band that we are generally comfortable and where we would like to operate with. If you had asked this question to me or anybody in CEAT, 2 years back, possibly we would have said we are comfortable in a margin of 12% plus or minus 1% level. Okay, with the increase in revenue, with a higher scale of operations, I think we are in a comfortable zone when we are in a 12 to 15% kind of a margin band. Okay, that's what I would like to say in terms of comfortable, because at that level is when we are able to generate reasonable amount of operating cash flows, leading to free cash flows that is helping us to invest back into the business, either through a marketing or on the product or on the capex side. So that's a comfortable margin, and it meets largely meets our ROC threshold. So that's our comfort zone.
Okay. So also talk to us about the demand, how it is shaping up. You know, we've seen an entire last 1.5 years when the auto sector has had to face multiple challenges, be it on demand. First, it was the two-wheeler segment, the challenges as far as the semiconductor issues were there, and ultimately that boils down to the ancillary makers as well. How has the demand panned out in the last 3 months, the October to December period, and vis-a-vis when we look at the previous 3 months as well, and the outlook going forward, both from two-wheelers, four-wheelers? What's the kind of demand that you're looking at now?
Sure. I'll talk more on year basis, because that would be a
Sure.
better comparison, because of some seasonality come into play here. In the quarter that went by, I think we had a strong growth in exports. We managed to bring that growth back in exports, and we could get about 20% kind of a growth in quarter three, year on year. So that was one which helped. And export will continue to be an important focus area for us. I'm happy to tell you that in the coming quarter, we are launching our passenger car radial tires and truck and bus radial tires in the US market. And similarly on agri radial tires, which is operating like a separate business unit, and a lot of investments have gone behind that. We have added capacities progressively in the last 2 years. Our capacity utilization has not caught up with the increase in capacities. However, we expect it to, improve from quarter four onwards. So therefore, that's another segment within the exports we expect to grow. Second, in the area where we had grown strongly in quarter three was in the replacement, and across the product categories, we managed to gain good traction and growth. In two wheelers, we managed to grow in strong double digits year on year. In commercial category tires, in the later part of quarter three, we were able to manage good growth. Passenger car radial tires in the replacement market, we were able to grow. So therefore, replacement market grew very well in these three categories. Last is original equipment manufacturers as a segment was something where the revenue remained flat, though there was some volume growth. We have process whereby whenever the raw material prices move up and down, it gets adjusted in the selling price. So therefore, value growth was flat, volume growth was in low single digits. That's the way the quarter three panned out for us.
Okay. Also tell us, sir, how was the performance of the replacement segment per se this time?
No, replacement, we grew in top line little over 7% in quarter three. And in passenger car, two wheelers, and commercial category at a later part of the quarter, we managed to get some good, almost a double digit kind of a growth.
Okay. What was the kind of ad spends that you had in this quarter, and going forward, are you looking at some more increase in the ad spends?
See, in general, our marketing cost is approximately about 2% of our turnover. Okay, and on an annualized basis, if you really look at it on an annualized basis, and the quantum amount of marketing spend would vary depending on the quarters. For example, whenever IPL event happens, our marketing spend tends to be a little on the higher side because we are present in much more present in IPL. So, but on a full year basis, that's where our range is around 2.1%. So marketing cost was a little lower in quarter three because of a lower level of activities on top line, and there was no specific large event that happened in quarter three. But if you really look at it cumulatively for the first 9 months, our marketing spend was approximately about 2%.
Okay, let me ask you a little bit on the expansion into the premium segment that you are looking at now, from road to off-road. You're launching some specific tires in that category. Give us more color of, what is your thought process like? Where is the company going to be headed? What kind of launches can we expect from you? And most of these are also high margin products. So what would that mean for you for the next fiscal year in terms of the launches that keep coming and the potential that that they will have to add on to your top line, bottom line, and the margins?
See, we are our core is passenger, so therefore passenger car radial tires, two-wheeler tires. In the order of priority, okay, they get a higher amount of importance, and so therefore when we allocate resources, whether it is a capital expenditure or a marketing support or any other manpower or other resources support, okay, these they get prioritized within the passenger segment. Another very important category, which is similar to passenger segment, is our agri radial tires or off-highway tires. It started getting focus of organization both in terms of capital resources as well as R&D and manpower resources. For the last 3 years, as we were able to establish that progressively in the overseas market. So these are the category where there are a lot of focus, where we allocate more capital and other resources. And with respect to premiumization, a lot of this premiumization play happens within this. I'm happy to tell you that last week we had launched premium two-wheeler tires, which is called as motorcycle steel radial tires. And these tires are largely used in the high-end two-wheeler segment. And today, these tires are largely imported into India and small volumes are locally bought. And these are high margin and highly priced tires. This is one thing which we have recently launched. Okay, and we hope to do well. And we have been approved also by some of the local OEM manufacturers who manufacture those high-end vehicles. From premiumization play, exports itself is also more profitable than others. We are launching truck and bus radial and passenger car radial tires in the coming quarter. And a lot of focus within the passenger car radial tires in India on high-end vehicles, higher inch tires in the OEMs as well as in the replacement. We'll continue to be participating with respect to OEMs on those high-end vehicles where we could supply tires. And there's a lot of focus in terms of selling those higher inch tires in the replacement market. That's the way we focus on our premiumization strategy.
Okay. Would you also be looking at expanding some of your capacities, sir, when you're looking at such launches coming forward? I think the company has also announced a, capex plan of 570 odd crore rupees. Tell us what is the plan in, what period of time that these expenses will be done. Are you looking at any fundraise for this capex?
See, if you really look at it, last 4 years of 5 years, we have spent a lot of capex in adding capacities. Okay, and we were less than half of our size 4 or 5 years back. And addition of these capacities in right categories and right locations has actually helped us in getting this growth and momentum. And so we added capacities in truck and bus radial tires. We added capacities in passenger car radial tires. We added capacities in two-wheeler tires. We added capacities in agri radial tires. And in the last 5 years, approximately about 5,000 plus crores of capex plan we had undertaken, and 80% of the amount has been spent. Okay, and without too much of strain on balance sheet. In fact, last 4 quarters, our balance sheet ratios, leverage ratios have seen a significant improvement from debt EBITDA of little over around 3 to we are now closer to about 1. Debt equity has come down also. So therefore, from leverage point of view, even after managing such a large capex, we have improved. Now, there are two things, I just want to explain to you. One is our business is a capital intensive business. Okay, and we have to keep adding capacities to get that growth. And the tire industry will grow. World is looking for, alternate source or a reliable source. And India is in a good position to take advantage of that. So therefore, it's possible for us to focus more on international market in addition to the local market and get that growth. And we'll keep adding capacities. In the current year, our capex, we expect it to be in the range of 800 to 850 crores, maybe somewhere in midpoint is where I think we'll end up with. And we have already spent 605 crores in first 9 months, and we hope to spend a little over 200 crores in Q4. And the 570 crores that of approval that we obtained from the board yesterday was more towards, keeping ourselves ready in terms of upstream planning and layout planning for expanding the requirement of FY26 beyond, or so FY27, so that you get your plans ready, so that you can plan and start working on longer lead time items. We are also going to spend some money in adding some additional facility in our existing specialty business to participate more in the premium part of OHT tires or agri radial tires. Third one is also something on solar, and little bit of in the past capex when we have completed the project, little bit of overrun is also going to be funded. That's the way the 570 crores stack up. I think we will continue to be spending capex of the range of 800 to 1000 crores per annum, so that we are able to support growth. The last point with respect to fundraising, look, our ratios have only improved. Debt EBITDA is 1. We are generating enough amount of operating cash flow leading to some free cash flows. We'll go by how things unfold. At this point in time, last 12 months, we have reduced our debt from 2,300 to 1,700 crores. Should any of those expansion plans need some, debt funding, we will look at it at this point in time. Based on our own current generation, largely we should be able to manage it from internal accruals and little bit of debt as and when it is required.
Okay, well, on that note, thanks a lot, Mr. Subbiah, for being with us on this special edition and explaining all the insights from these quarterly earnings as well as the outlook going forward with all our viewers. Yes, wishing you all the very best for the upcoming quarters as well, and hoping that we can catch up again to get more insights on the industry as well as the company going forward.
Absolute pleasure. Thank you.
Thank you so much. And with that, we will wrap up this very